Welcome back to the deep dive. This is where we take a stack of sources, your articles, your research, your notes, and turn that raw data into distilled, actionable knowledge.
We're here to give you that ultimate shortcut to being well-informed.
And today we are opening up the financial control panel. We are not just talking about, making ends meet.
Not at all. We are dissecting the core mechanics of personal wealth. We're trying to move beyond just simple budgeting to really understand the dynamics of cash flow.
And the reality that's captured by your balance sheet, right?
Exactly. And then using the mathematical ratios that, well, they act as your definitive financial report card.
That's the mission. Our goal in this deep dive is to give you not just a theoretical understanding, but a true sense of confidence and financial empowerment.
I think when you understand the metrics, you really stop reacting to your money.
And you start directing it. We're going to break down the principles of personal financial evaluation, from categorizing expenses to asset classification, and really dig into the powerful metrics that define financial health. Okay, let's unpack this.
So if we look at the core engine of all this, everything in personal finance, it really begins and ends with managing cash flow.
It sounds so simple when you say it like that.
It does, but it's really an art. It's the art of precisely balancing two things: the timing of the money coming in and the timing and the amount of the money going out.
For most people, though, especially if you have a regular job, that synchronization can feel almost automatic. You get paid on the 30th, you pay your rent on the 1st.
That's what you'd think. But it's that slight gap, that tiny variance in timing that the sources warn us about again and again.
A variance of just a day or two.
Precisely. That slight variance, or maybe a small unexpected need that pops up just before payday, that can instantly lead to the need for costly, high-interest debt.
You mean like a credit card advance or dipping into an overdraft?
Exactly. And debt, fundamentally, means interest. That interest then becomes an extra mandatory outgo that acts like a perpetual drain on your finances.
So it immediately reduces your ability to save or cover the next expense.
It's a vicious cycle. The flow of money dictates your stability, or, your lack thereof. This timing issue is far more critical than people realize.
Can you give us a concrete example of that?
Sure. Let's say you have a salary of $8,000, and $7,500 of that is already budgeted for expenses.
Okay, a pretty tight budget.
A very tight budget. Now imagine your income arrives on the 5th of the month, but $4,000 of your largest expenses, mortgage, car payment, school fees, are all due on the 1st. Where does that $4,000 come from for those 4 days? If you don't have a buffer, you're forced to rely on credit, even though you know for a fact the money is coming soon.
So this is the difference between being solvent, owning more than you owe overall, and being liquid.
That's the perfect distinction. Solvency is the big picture. Liquidity is having the cash right when you need it.
And what we're ultimately aiming for here isn't just surviving that 4-day gap. We want to be consistently generating a surplus, right?
That's the goal. The whole point is to accumulate savings, not just for retirement decades from now, but for the difficult times, for those unexpected needs.
And maybe most importantly, to alleviate the crushing psychological burden of financial stress.
The sources make a very strong connection between financial mismanagement and personal well-being. They're very clear that chronic money worries don't just hurt your wallet.
It's more than that.
So much more. They create tension that disrupts family peace, they lead to arguments, and they cause legitimate health problems that are rooted in high anxiety.
So a structured approach to cash flow management it's really an investment in your mental health.
It absolutely is.
So if that's the payoff, how do we start? Where's the first step?
Well, the role of a financial advisor, or really just the basic exercise you can do for yourself, is to help you map this financial terrain. You must first understand all of your income sources.
Every single one.
And then meticulously trace the exact application of those funds within a typical month. You need visibility. So when we start listing income, clarity is paramount. We have to first distinguish between what we call regular income, so your standard monthly salary, or fixed rental payments.
Your predictable stuff.
Right. And then we separate that from infrequent income. And that includes things like annual bonuses, investment payouts, a tax refund, or maybe a one-off commission.
Why is separating those two types of income so critical? It's all money coming in, isn't it?
It is, but relying on infrequent income to cover your regular, recurring monthly expenses is one of the quickest paths to instability.
How so?
Well, if you budget your rent based on receiving an annual bonus every October, and that bonus is, let's say, delayed by a month or it's reduced, your entire monthly budget just collapses for the rest of the year.
Because you were counting on a big lump sum that didn't materialize exactly when you needed it.
Precisely. Regular expenses demand regular, predictable income. Infrequent income should be treated as a windfall something to direct towards savings or specific goals, not to finance your daily living.
That distinction makes perfect sense. Okay, now let's move to the expense side, which the sources classify into three crucial tiers. You're saying this classification is the blueprint for gaining control.
It is. It's what transforms a messy spending record into an actionable budget. These tiers, they define your flexibility or your lack of it.
All right, what's the first tier?
First, we have mandatory expenses.
Hmm.
These are the non-negotiable amounts that must be compulsorily spent. This includes things like income taxes, fixed loan repayments, your EMIs.
So mortgages, car loans.
Exactly. Required insurance premiums and statutory deductions like certain retirement contributions. You can't skip these without severe long-term consequences. It'll impact your credit score, your legal standing, your future security.
So these are the fixed costs that define the absolute floor of your spending.
Exactly. Next up, we have essential living expenses. Now, these are costs that are absolutely necessary for daily living. Think groceries, utilities like electricity and water, basic health care,
Transportation to get to work.
necessary transportation, yes, and basic clothing. While you need these things, they're variable. You can often optimize them.
How do you mean optimize?
Well, you could switch utility providers for a better rate. You could cook more meals at home instead of getting takeout, maybe take public transport instead of a taxi. There's some control there.
And finally, the category that offers the biggest lever for change, discretionary expenses.
This is the critical area for financial control. These are expenses based entirely on lifestyle choices that could be cut, reduced, or eliminated if needed.
So this is the fun stuff, usually.
It's the fun stuff, but it's also the flexible stuff. Entertainment, high-end streaming subscriptions, eating out frequently, non-essential travel, expensive hobbies, designer purchases. If you are struggling to generate a surplus, this is the first and often the only lever you can immediately pull to increase your savings rate.
Before we move on, there's a nuance in the source material we need to address, specifically around the concept of savings. It's not as simple as it sounds.
Yes, that's a great point. Most people, they look at their monthly paycheck and they see a figure, their monthly surplus in hand. This figure has already had mandatory deductions taken out of it.
Things like contributions to a public provident fund, or PF, or a mandatory company retirement plan.
Exactly.
But wait, if those are mandatory deductions, aren't they just expenses?
They are expenses out of your immediate cash flow, that's true, but they are not lost money. They belong to you, the investor, and they're being set aside for your future.
Ah, I see.
Therefore, your true savings figure is actually the amount left over in hand, plus those mandatory contributions that are directed toward your future goals. You arrive at your true savings by adding those mandatory contributions back to your in-hand surplus.
That's an empowering way to look at it. It shows your actual commitment to your future wealth, which is often higher than you might think.
It reframes the whole picture.
Here's where it gets really interesting. We've talked about the paper figures, the budget, the calculated surplus, but those income and expense figures have to be backed by actual operating cash.
A surplus that only exists on a spreadsheet is, well, it's useless for immediate needs if the cash isn't physically available in your checking account.
So this is what you call the distinction between accrual accounting and cash accounting.
Exactly. Accrual is what you've earned or spent on paper. Cash is what physically moved into or out of your bank. This gap is a massive source of stress for people.
Can you give us an example of that gap?
Sure. Your gross salary might include various allowances or specific expense reimbursements, say for travel or a medical flex spending account that you haven't yet filed the paperwork for or claimed.
So on paper, my total income for the month looks high, but the money that actually gets deposited into my bank is significantly lower until those claims are processed.
Precisely. And if you budget based on that gross number, you will find yourself running short every single month, just waiting for the reimbursement checks to land.
So the smart way to budget is based on actual cash inflow.
Yes, excluding any funds that are dependent on future claims or processing. Always budget on the cash you know you will have.
This leads directly back to that classic cash crunch problem we touched on earlier.
It's the timing mismatch in action. If most of your mandatory expenses, your rent, your loan, EMIs, school fees, are concentrated at the beginning of the month, say the 1st through the 5th,
And your salary only lands on the 1st or the 5th.
you have zero margin for error. If that salary is late by one day, or if you have an unexpected car repair on the 2nd, the entire system instantly breaks down.
It's so fragile. So how do we handle these short-term timing issues without resorting to expensive credit?
The sources suggest two very structured approaches. The first, and the simplest, is to maintain a sufficiently large surplus balance in your bank account at all times,
A buffer.
a perpetual buffer. It insulates you from these day-to-day timing issues. We're talking about maybe 10 to 15 days worth of essential expenses just sitting liquid in the bank, always.
Okay, what's the second approach?
The second approach is a bit more sophisticated, creating a separate, dedicated fund specifically for short-term mismatches.
And this is different from an emergency fund.
Completely different. Your true emergency fund is for a major crisis, like a job loss or a medical emergency. This mismatch fund is purely operational. It's a dedicated pool of cash you use to pay the bills due on the 1st, which you then replenish when your salary lands on the 5th.
So it just manages the flow, ensures you avoid late fees, and keeps you liquid day to day.
Exactly. It's a simple, elegant solution.
Okay, so once we have that cash flow organized and the budget is set, how do we track and formally assess the performance of that budget?
That's where the income and expenditure statement becomes so vital. This tool provides a clear view of your actual financial flows for a specific period, be it a month or a quarter, which you then hold up against your initial budget.
And you mentioned this is different from just looking at a bank statement because it accounts for items not yet paid, like a credit card bill. Can you expand on why that makes it superior?
Absolutely. A bank statement is pure cash flow. If you look at your April bank statement, it shows the credit card payment you made. But that payment was for March's consumption.
Right. It's looking backwards.
It is. The income and expenditure statement, however, operates on an accrual basis. It reflects the expense when it was incurred. So if you went on a big shopping trip in April, the I&E statement captures that consumption and expense in April, even if the cash payment for the credit card isn't actually due until May.
So this gives us a true picture of our consumption habits during that month.
Exactly. It reveals the true extent of the surplus you generated, and it clearly identifies which expense categories, groceries, entertainment, transportation, were over or under budget. That allows for meaningful corrective action,
It moves us away from just tracking transactions and towards analyzing our actual behavior.
which is the whole point. And this leads us directly to the first step in true financial prudence, moving from reactive saving to proactive planning.
What does that shift look like?
Prudent management means targeting a defined level of savings from the start. You're not just saving what's left over at the end of the month. That's the ad hoc approach.
The hope for the best method.
Right. Instead, you define the exact amount necessary to meet your future goals, be it a house down payment or retirement, and you manage your expenses backward from that mandated savings target. Setting that target is the crucial bridge from basic cash management to comprehensive, strategic financial planning.
Which brings us nicely to Section 2, making that plan dynamic and forward-looking. Let's nail down the structure again for everyone. We've outlined the 4 steps to making a robust personal budget. 1. Total up all your regular incomes.
Predictable stuff, yes.
2. Deduct those mandatory expenses. 3. Deduct essential living expenses. And 4. Deduct the flexible discretionary expenses.
This hierarchy is absolutely key because it defines where you have control. If your income is fixed, which it is for the vast majority of people, then enhancing your savings relies almost entirely on managing and cutting expenses.
And discretionary costs are the only immediate, easy target.
They are. The mandatory and essential expenses require more structured, long-term interventions.
And sometimes those mandatory costs, specifically the loan payments, are just too high. They cut into the essential or discretionary funds before we even get started.
That's when the strategy of debt rationalization comes into play. This is a proactive process, often undertaken with a professional, to reduce the overall burden of high mandatory loan repayments.
What would that involve?
It could be anything from refinancing a mortgage at a lower interest rate to consolidating several high-interest debts into a single lower-interest personal loan, or aggressively paying down the principal on the most expensive debt first. The goal is always to free up future income by reducing that mandatory drain.
So budgets are static when they're written, but life is, as you said, dynamic. We have to look ahead, which means we must talk about forecasting.
Yes. Forecasting is the ability to look ahead and estimate future financial figures based on your current data and, importantly, your expected future conditions. It's not just guessing, it's about modeling.
So you take your current data, your stable expenses and income, and project them forward, adjusting for things you think might change.
Exactly. And what makes forecasting dynamic is that it must account for evolving conditions. If you forecast your budget for the next 5 years, you have to factor in assumptions that will change.
Like what?
Potential salary increases, for one, inflation rates impacting your essential expenses like groceries, a planned expense like a child starting college, or the expected rise in interest rates affecting your variable loan payments. A static budget becomes useless the moment conditions change.
But a dynamic forecast lets you prepare for those changes.
It does.
And if it's so complex, why rely on experts? I mean, doesn't the individual know their own life best?
They do know their life best, but experts bring crucial macro knowledge. An individual may not know how complex global or national factors like central bank policy or specific tax law changes will impact their specific investments or liabilities.
So they see the bigger picture.
Right. Expertise improves forecasting by providing insight into how economic levers behave under different circumstances. However, the beauty of it is that the individual's own experience improves over time. The more you forecast, meticulously track the results, the better you understand your own financial behavior.
So once that forecast is made, how do we hold it accountable?
Through monitoring. Monitoring is the indispensable twin of forecasting. Its primary purpose is to rigorously record your actual income and expenses and see if they align with your initial dynamic budget. This variance, the gap between what you planned and what actually happened, gives you critical feedback.
And that feedback tells you if your assumptions were wrong or if your behavior needs to be corrected.
Precisely. Let's go back to a practical example. Suppose your monitoring reveals that your conveyance expenses, your transportation costs, are consistently 30% higher than your forecast.
Okay, that's a big gap.
It's a huge gap. It means your budget was either way too optimistic or your behavior is inconsistent with your plan. Corrective action is mandatory at this point.
What are the choices?
You now face two stark choices. You must either formally raise the budget figure to reflect the reality of your current transport mode and accept that this eats into your savings potential, or
you have to make a behavioral change.
you must. You have to actively change your mode of transport, maybe shifting from your personal car to more public transit or carpooling to reduce that expense. You cannot simply ignore a persistent gap and hope it fixes itself.
When should this review cycle happen? Weekly? Monthly?
Ideally, the formal, comprehensive budget review happens at the end of the month, once all the transactions have cleared and your income and expenditure statement is complete.
But that feels like it could be too late sometimes.
It can be, which is why the best practice is consistent record keeping that allows for mid-month adjustments. If you see your discretionary spending creeping up significantly by the 15th, you have the opportunity to hit the brakes before the end of the month and prevent a complete budget overrun.
Ultimately, all of this structure, all this forecasting, it's all focused on that one objective: making sure your income consistently exceeds your expenses.
And generating a reliable, defined level of savings for your future.
But what if you've gone through this whole process and the gap between your actual savings rate and your desired savings rate, the amount you need to hit your goals, is just paralyzingly huge?
That's a common feeling, and it often leads to inaction. The sources are clear. The antidote is a step-by-step approach.
You don't try to climb the whole mountain at once.
Exactly. You don't aim for the 5-year goal immediately. You break it down into manageable chunks. If you currently save 10% and you need to save 30% for your goals, maybe set a target to raise the savings rate by a solid 10% in the next year.
By targeting just one category of discretionary spending, for example.
Yes, it makes it feel achievable. You build momentum, and breaking down the goal makes the impossible seem possible.
This strategic management also applies to how we handle those infrequent pieces of income you mentioned earlier, the windfalls.
Absolutely. Large, one-time receipts, a significant annual bonus, an inheritance, a big tax refund, should be directly diverted towards savings or debt reduction.
Don't let it just sit in your checking account.
Never, because it will get spent. This allows you to drastically boost your overall savings rate or reduce expensive liabilities without requiring you to fundamentally alter your day-to-day spending habits. It's a powerful accelerator.
I want to focus on what you identified as a huge danger for rising professionals: the trap of new income.
Lifestyle creep.
Exactly. When someone gets a raise, the immediate temptation is to commit that new, higher income to a new, higher level of expenses. A nicer car, a bigger apartment, more expensive leisure activities.
It's rooted in human psychology. We call it hedonic adaptation. We very quickly normalize the new, higher standard of living. The sources are absolutely clear on this. Higher income should not be immediately committed to new mandatory expenses.
So what should you do instead?
Leave it uncommitted for as long as possible. Let it contribute maximally to your savings rate and accelerate your long-term goals. Here's a practical tip. When you receive a raise, try to continue living on your old salary for at least 6 months.
And direct the entire raise straight into savings or investments.
100% of it. Immediately upon receipt. If you immediately commit that new income to a higher mortgage payment or a long-term car lease, you lose that financial freedom forever. You've just raised your mandatory expense baseline, and the new income is gone without improving your net worth.
That's a powerful distinction. Okay, we've thoroughly discussed the flow of money, the income and expenditure statement. Now we need to shift gears and look at the snapshot of wealth.
We're moving from the flow, which is like a video, to the stock, which is like a photo. The tool we use for this is the personal balance sheet. Its purpose is very defined to show the comprehensive financial position of an individual or household in terms of what they own, assets, and what they owe, liabilities, all frozen at a single specific date.
And this gives us the only clear view of our net worth.
It does.
So what constitutes the asset column for the average person?
Well, assets are split by liquidity. On the shorter-term side, we track current assets, cash, bank balances, short-term fixed deposits, and any expected advances. This is your immediate liquidity.
And long-term.
On the long-term side, you list property, so real estate, gold, long-term investments like retirement accounts, stocks, mutual funds, basically everything you possess that has monetary value.
And the most important metric derived from the sheet is net worth.
Net worth is defined simply as the difference between your total assets and your total liabilities. If you liquidated every asset you own and paid off every single debt you have, net worth is what would remain.
So why is net worth the more relevant figure than just looking at total assets? I mean, someone could have $2 million in assets and feel very wealthy.
Because that $2 million in assets might be offset by $1.5 million in liabilities, meaning their true ownership, their net worth, is only $500,000. Net worth shows your true ownership after all your debts are settled.
It's the only number that matters for measuring genuine, sustainable wealth accumulation.
It is. It also brings a lot of clarity to the definition of financial stability.
How?
Well, your household finances are stable when the flow, your expenses, is managed comfortably within your income, and a surplus remains to save and grow your assets. Conversely, excessive loans fundamentally undermine stability because they create a high liability and, crucially, an ongoing mandatory cost interest that perpetually strains your future income stream.
So debt introduces these rigid obligations that make your financial life brittle.
Very brittle.
Okay, let's break down the types of assets because they behave very differently. We have physical assets versus financial assets.
Right. Physical assets are the tangible things.
Right.
Real estate, gold, commodities. Historically, they're often seen as effective hedges against inflation because their prices generally show a positive correlation with inflation. They tend to retain their real purchasing power over time.
But they come with some distinct challenges, especially for a modern investor.
They certainly do. They're often highly illiquid. It takes a lot of time and effort to turn a piece of real estate into cash. They're often unregulated, and they require substantial capital. They're large ticket items.
So you usually need large loans to acquire them.
Which instantly reduces your net worth by increasing your liabilities. You can't just easily sell a piece of your house if you need $5,000 for an emergency.
Now, compare that with financial assets.
Financial assets are claims on future benefits. So we're talking about bank deposits, stocks, equity shares, bonds, mutual funds. Their core advantage is standardization.
Meaning they're easy to compare.
Right. Since they're regulated and treated, their evaluation and comparison are far more efficient. An equity share, for instance, represents a claim to periodic dividends and potential appreciation, all of which are easily tracked and benchmarked against its peers.
However, the accessibility of financial assets can tempt people into taking on excessive risk.
Yes, especially with leveraging. Taking loans specifically to buy financial assets or trading on margin is inherently risky. Asset prices, particularly in the equity market, are highly volatile.
So if you borrow heavily to buy assets that then fall in value,
you could quickly find yourself in a margin call situation or owing more than the entire asset is worth. It can destroy your net worth almost overnight.
Net worth, then, serves as the ultimate reality check of all our budgeting and investing decisions.
It must be calculated periodically, say, every 6 months or annually, to track your progress. It tells you if your overall financial strategy is actually working.
The sources use the example of a person named Lakshmi to illustrate this.
Right. So if Lakshmi's net worth calculation shows a surprisingly low figure, it's often because most of her major assets, like her house and car, were acquired through large, long-term loans. And a significant part of that debt is still outstanding,
So even though she has high total assets, the liabilities negate much of that value.
resulting in a low or even marginal net worth. It's a very common situation.
That makes the integrity of the budget absolutely critical. If we miss areas of spending, the net worth snapshot gets distorted.
The wider the coverage of your income and expenses, the more accurately your budget, and subsequently your net worth calculation, reflects the true situation. People frequently struggle with irregular or infrequent costs, those non-monthly items that sneak up on you.
How do we bring those unpredictable or infrequent items into a structured monthly budget? Let's take that foreign holiday mentioned in the sources, say, once every 3 years.
You apply the principle of the annualized equivalent. If that dream holiday costs, say, $10,000 every 3 years, you have to mentally treat it as an expense of about $3,333 per year.
Or roughly $278 per month.
Exactly. You then budget to save that $278 every single month into a dedicated sinking fund for that holiday. You do the same for seasonal price spikes, like high winter utility bills. You either budget a slightly higher average amount year-round or allocate a contingency figure to ensure the budget remains robust.
Okay, so once we've done the hard work of creating a surplus, how do we make sure that money actually gets saved and invested rather than just being spent inadvertently?
You make savings automatic. This is done negotiable. The simplest and most powerful strategy is a direct transfer, a standing instruction, from your salary account to your investment or retirement accounts each month.
And you schedule it for right after your paycheck lands?
Immediately after. This transfer has to happen before the money is available for any discretionary or even essential spending. It's the pay yourself first principle, but it's enforced by technology.
Let's pivot to contingency planning. We talked about job loss, but what about the specific dynamics of a double-income household?
For a household with 2 earning members, the primary financial risk is, of course, the interruption of income for either person. The great advantage here is that the double income itself acts as a significant form of job loss insurance.
Because if one person loses a job, the other still has income, ensuring the core household expenses are still met.
Right, although it would require an immediate and significant tightening of discretionary spending.
So given that risk, what is the absolute first goal of savings, regardless of any other goals?
Building a robust emergency fund. This fund is there to protect against a sudden loss or reduction of income, a major medical event, or other true unforeseen emergencies.
And the sources provide a pretty sophisticated way to manage that fund, the laddered approach. We should be really clear about how this works.
The laddered approach is all about balancing safety and return. You should hold the most immediate portion of the fund, typically enough to cover 3 months' expenses, in ultra-liquid assets.
Like a high-yield savings account or an overnight money market fund.
Things you can access instantly, yes. The remaining necessary amount, say up to a total of 6 or 8 months' expenses, can be held in less liquid assets that provide slightly better returns. Perhaps short-duration debt funds or fixed deposits that mature quickly.
So this strategy recognizes that while you need instant access for the first few months, you might not need the whole amount immediately, so you shouldn't penalize the entire sum with ultra-low returns.
That's the logic. And crucially, the fund must be replenished as soon as possible after any use. It's your number 1 priority.
And when do we review the size of this fund?
Annually, at a minimum. And critically, whenever a large recurring expense is added to your budget, like a new EMI for a car or a house or a child's new tuition fee, you have to adjust the size of the emergency fund upward to cover that new, higher monthly expenditure baseline.
Finally, a quick practical note on asset distribution and monitoring for couples.
Yes, financial advisors always emphasize ensuring a healthy distribution of assets between spouses. This is for estate planning and tax efficiency. It means intentional ownership. Spouse A is the first holder in some assets, spouse B in others.
And what about bank accounts?
Even if a couple shares joint financial goals, keeping distinct salary accounts helps dramatically with better expense monitoring, individual investment tracking, and accurate tax management. It just gives both parties full clarity over their individual contributions and spending habits.
That completes the snapshot. We have the flow, we have the stock. Now, let's apply the metrics that give us the grade, the financial report card.
This is where we distill everything down into quantifiable performance metrics. Personal finance ratios are incredibly powerful because they provide a numerical snapshot that bypasses emotion and instantly identifies areas needing strategic intervention.
And the key is using them consistently, not just once.
Absolutely. They should be calculated periodically, we suggest once a year, to allow you or your advisor to track the trends and measure the efficacy of the actions you've already taken.
So if you implement that debt rationalization strategy this year, the debt-to-income ratio next year should clearly show the improvement.
It should. And we must also stress that standard financial benchmarks must always be customized to reflect your individual life stage, your income level, and your specific goals. A benchmark for a 25-year-old is not the same as for a 55-year-old.
Okay, let's start with the most fundamental metric of all, the savings ratio. Hashtag tag 1. Savings and expense ratios.
The savings ratio formula is very simple. Savings per year, annual income. This tells you the exact percentage of your total earnings you successfully divert toward wealth creation.
And just reminding everyone of that key nuance from Section 1, how do we define savings for this specific calculation?
Right. Savings must include all money directed toward future goals. This means the actual cash surplus you invested plus any mandatory or statutory deductions, like money in a public provident fund or your company's mandatory retirement contribution.
Because that contribution ultimately belongs to the investor and represents accumulated wealth.
It does.
Let's work with the example from the sources. If an individual has an annual income of, say, 10,200 rupees and total annual savings of 3,200 rupees,
Right.
what's the ratio?
You'd take 3,200 and divide it by 10,200. That gives you 0.3137 or 31.4%.
And is that good?
That is a highly respectable savings rate. It suggests a strong focus on future security. Now, if your goal is very aggressive retirement, you might want to benchmark higher. If you're in high expense years, like raising young children, 31.4% might be outstanding. The context always matters.
In direct contrast to this, we have the expenses ratio
Which is just the other side of the same coin.
in the formula.
Annual recurring expenses,
Yeah.
annual income. But mathematically, it's simply the inverse of the savings ratio. Expenses ratio into one savings ratio.
So in our example, if you save 31.4%, your recurring expenses ratio is 68.6%.
Correct.
When calculating those expenses, what about that unexpected root canal or the one-time disaster repair for the roof?
We must be careful to exclude truly one-time, non-recurring, non-budgeted expenses, unless you're trying to calculate an average cost for a typical year. The goal here is to measure your recurring consumption against your recurring income.
And if that expenses ratio is too high, the improvement lever is almost exclusively in reducing discretionary expenses.
Almost always. As the mandatory and essential categories, they require those long-term structural changes like debt rationalization or moving to a cheaper house. Hashtag 2. Accumulated savings and liquidity ratios.
So we've looked at the flow with the savings ratio. Now let's look at the accumulated stock of wealth with the next ratio.
This is the accumulated savings to income ratio. This measures your overall preparedness to meet major long-term goals like retirement or a child's education. It compares the total pile of money you have saved to your current annual earning capacity.
What exclusions apply here? What doesn't count towards that accumulated savings pile?
We typically exclude the value of your self-occupied home and any personal use assets. They're consumption assets. You need a place to live, and you're not planning to liquidate it to fund your retirement.
And this benchmark is very stage of life dependent.
Very. The sources suggest that for someone in their early 40s, a suitable ratio is at least 3 times their annual income.
Wow. So if you earn $100,000 annually, you should have $300,000 accumulated in investment wealth by your early 40s.
That's the benchmark. If you're significantly below that, it's a red flag. It indicates you need to aggressively increase your savings ratio, and you need to do it immediately.
Next, let's address that crucial component of safety, liquidity.
Yes, the liquidity ratio. This measures your immediate financial safety net, your buffer against short-term disasters. The formula is liquid assets, monthly expenses.
How do we define liquid assets specifically for this ratio? It sounds like it's more than just what's in your savings account.
It is. Liquid assets are defined as those funds that can be easily and reliably converted into cash at short notice without a loss of principal to meet emergencies. This includes bank deposits, cash holdings, and some short-term debt instruments.
And crucially, assets like stocks or equity investments are often excluded from this definition.
They are for the purposes of this specific ratio.
Why exclude stocks? I mean, you can sell them in minutes.
Because of price volatility. While you can sell them quickly, you cannot guarantee the price you'll realize. If the market is down 20% on the day you need cash for an emergency, selling your shares means you'd incur a loss and you'd fail to realize the specific amount required to cover your expenses. Liquid assets must be reliable for a specific monetary amount.
Now, what's a good benchmark for this ratio?
A comfortable liquidity ratio is typically between 4 and 6. This indicates you have coverage for 4 to 6 months of expenses, which aligns perfectly with our emergency fund goal.
This ratio leads us to a key conceptual trade-off, what you call the cost of liquidity. You mentioned that liquid assets usually earn lower returns. Why is that so important to understand?
It's the constant tension in finance. Safety versus growth. When money is instantly accessible and highly safe, that is, liquid, it generally earns very low returns, like a savings account. Think of it as paying an insurance premium for that immediate access.
So what's the danger of being too liquid?
If your liquid assets to net worth ratio is very high, meaning a large percentage of your total wealth is just parked in low-return, highly liquid assets, it suggests your savings are failing to work hard enough for you. It's actually hindering your ability to meet your long-term growth goals. You have to strategically shift funds out of low-return liquidity and into growth assets once your safety buffer is fully met. Hashtag 3. Asset composition and solvency ratios.
Okay, moving on to the composition of your wealth. Are you heavy on property or on paper assets?
That's measured by the financial assets ratio, which is financial asset total assets 100. This tells you what proportion of your total wealth is held in investments like stocks, bonds, and deposits versus physical assets like gold and real estate.
When would a high financial assets ratio be preferable?
A higher proportion of financial assets is generally preferred when your major financial goals like retirement are getting closer to realization. Financial assets are just easier to liquidate, they're standardized, and they can often be structured to provide reliable income streams, which is exactly what you need in retirement.
And just to reiterate, what gets excluded from our asset totals when we are planning for future goals?
We exclude personal jewelry, the one residential house you live in, and any personal use assets like your car. These items are non-liquid lifestyle components, not resources that are actually available for funding your retirement or college tuition.
The next ratio determines if the whole financial structure is even sound.
This is the solvency ratio. Net worth and total assets. This is a critical check. It shows the proportion of your assets that are truly owned by you, free and clear of debt. And it indicates your ability to meet all your obligations if everything were to be liquidated today.
The critical benchmark here is simple but powerful.
Your net worth should be unequivocally positive. If your solvency ratio is 0 or negative, you are technically insolvent. Your debts outweigh your total possessions. While this is rare outside of severe financial distress, it is the ultimate measure of your financial health. Hashtag 4, debt management ratios.
Finally, we have to look at how well an individual manages borrowing, because this is often the primary source of financial strain.
Yes, and we first have to distinguish between the types of liabilities. You have long-term secured liabilities, which are usually for purchasing assets, like a mortgage or a car loan. They typically come with lower interest rates.
And then there's the other kind.
Then you have short-term unsecured liabilities, like credit card debt or personal loans taken for consumption. These are often much more expensive and were not used to build any equity. The unsecured debt is the most corrosive to your net worth.
So how do we measure the extent of our debt against our total wealth?
With the leverage ratio. Total liabilities as total assets. This shows how much of your total asset base is financed by external debt.
What does a high number here signal?
A ratio greater than 1 signals immediate danger. Your assets are inadequate to meet all your liabilities. You are, in effect, underwater. However, context is vital here. A high ratio is absolutely expected immediately after you purchase a large ticket asset like a new home with debt.
But the key is that this ratio must trend significantly downward over time.
Yes, as you aggressively pay off the principal and build equity. If it's still high 5 years after buying the house, you have a problem.
And the final and perhaps most actionable ratio relates debt back to our monthly flow.
That is the debt-to-income ratio, or DTI. This measures your current income's ability to comfortably service or meet all your debt obligations. It's the litmus test for monthly financial strain. The formula is monthly debt servicing commitment monthly income.
And this includes all your loan payments, your mortgage, car payments, and the minimum credit card payments.
Correct. Every mandatory debt payment. The benchmark here is crucial. A ratio higher than 35% to 40% is considered excessive, even dangerous.
Why dangerous?
Because if more than 4 out of every $10 you earn is immediately committed to servicing debt principal and interest, you are leaving very little flexibility for essential living expenses, savings, or handling any unexpected event. A high DPI means you are highly vulnerable to the loss of a job or a sudden medical bill.
So keeping this ratio low, ideally below 30%, provides the crucial buffer necessary to maintain control over your cash flow.
It does. It reinforces the entire financial structure we've built. Hashtag outro.
This has been a complete financial overhaul. We started at the absolute foundation of cash flow management, emphasizing the critical timing differences and that distinction between paper income and actual cash in your hand.
We then structured spending using those critical levers of mandatory, essential, and discretionary expenses to find where the control really lies.
We moved into strategic planning, highlighting the importance of dynamic forecasting and targeting a defined level of savings rather than just, saving what's left over.
We then analyzed that static snapshot of wealth using the net worth equation, stressing why assets acquired by debt lower your true ownership, even if they look impressive.
And finally, we applied the key performance indicators, those powerful financial ratios, from the savings ratio, which measures your growth commitment, to the debt-to-income ratio, which measures your monthly strain, and the liquidity ratio, which quantifies your safety net.
This entire structure really allows you to move from being a passive observer of your finances to an active financial manager.
So what does this all mean? It means you now have a comprehensive set of tools to diagnose and customize your own financial map, knowing exactly which calculation to run and which expense category to target to achieve your specific long-term goals.
And remember, the objective is continuous, informed improvement. Use these ratios not merely as static numbers once a year, but as a dynamic feedback mechanism. A sustained drop in your savings ratio signals an immediate need to tighten discretionary spending.
Or a high liquidity ratio signals that you need to strategically shift funds into higher return assets.
Exactly. They are the efficacy check for every single financial decision you make.
We learned that solvency requires a positive net worth, but achieving robust liquidity, that safety coverage for 4 to 6 months of expenses, comes at a definite cost: lower returns. How do you strategically balance the imperative for immediate safety, liquidity, with the long-term need for wealth growth, especially when your savings target is aggressively set at 3 times your annual income? That strategic tension is the challenge to take forward.